All right, the next section of the analyze that we're going to focus on in this module is the loan, the finance section. So here we are. I'll make my screen a little bit smaller so it's easier to see. Scrolling down, senior loan metrics, this section right here. This is the part we're going to focus on. So I'm going to zoom in a little bit. Go to 150%. All right. So this is where you plug in all the information about what type of loan you're going to get. With commercial real estate, there are basically, there are a couple options. There's bridge debt, there's agency debt, and then there's a local bank or a local credit union. There are benefits and drawbacks to all three, but we're going to make the assumption that we're working with a local bank on this deal, right? So first off, is there an interest-only period? So for our purposes, we're going to say no, there's no interest-only period where the loan is amortized from day one. So there's no period where it's interest-only. So if there were an interest-only period, we would update this number right here, say a 6-month interest-only period. But in this situation, for this training module, no, there's no interest-only period. How much is the bank going to loan you relative to the purchase price? 70%, 60%, 80%? When you talk with the lender, that's a very important question, because then you know how much cash you will have to bring to the table from investors for the down payment. It is going to be rare to get a loan as high as 80% loan to value. So in this situation, we're going to assume that the bank will give us 75% of the purchase value. There is no CapEx, so it is irrelevant how much the bank is financing of the CapEx in this situation. Plug in the interest rate, plug in the amortization years, and you have all the information that you need. If there's a prepayment penalty, the bank will have that on the term sheet that they give you. You can plug it in here. Now, here's something just in general, talking about lending, right? With commercial lending, it's different than residential lending. For a residential mortgage, you qualify for the mortgage, you get it, you're done. With commercial lending, it's different, right? In order to qualify for a commercial loan, you have to have the net worth equal or greater than the amount of the loan. So let me go back. So in this case, you will have to have a net worth of $825,000 to qualify for this loan. You will also need liquidity of at least 10% of that amount. So you have to have a net worth of $825,000 and liquid assets of $82,500. This is where a loan sponsor becomes a critical piece of the team. We talk about the 3 pillars of a deal. You got to have the property, you got to have the investors, and you got to have the loan sponsor. If you don't qualify for a commercial loan, just like we didn't qualify for commercial loans when we got started, you will need a partner that can. That term is called a loan sponsor. Basically, they're guaranteeing the loan. They're co-signing on the debt. So the bank looks at y'all as a team and says, oh, yes, this team has the liquidity. They have the net worth. They qualify for the loan. That's one of the reasons why we built the network of the deal room, so that people can build relationships with loan sponsors as they're building their net worth, as they're building their liquidity. So if you don't have it, you need to partner and build a relationship with someone who does, which is one of the things that we do inside the deal room. So here we go. Senior loan metrics, pretty simple. Plugging that in. We're not going to talk about owner financing right now. We're not going to talk about refinance loan metrics in this module. We're going to hit refinance in the next module.